I think about some of the mistakes that I feel like I've made in my own life, and it's usually getting out of something that I shouldn't have. Like I think about real estate. If I had held on to every real estate holding, would I be better off? And I think the answer would be yes, right?
Welcome to the Cashflow Academy podcast. Andy Tanner here, and I'm joined by my good friend Corey Halliday. How are you, Corey?
Yeah, I'm excited to be here. Moving on up, I'm in Noah's spot. Yeah.
Well, Noah, we wish him well for sure,
Yep.
because Noah's having. I guess he put the 3D image out on Mentor Club, so I guess he's not hiding his medical stuff, but he's having a major surgery today.
Yeah.
Noah broke his hip in a skiing accident, and he didn't break it, he destroyed it. So he's having pins, and I mean, he's lucky to be alive.
Yeah,
so
absolutely.
we wish him well, and we miss him for sure. So today we're going to speak a little bit about some of the common mistakes. And believe it or not, Corey and I make lots of mistakes. At least I do.
Yeah.
And we'll have those confessionals. But before we do, just a reminder to drop by yourinvestingclass.com. People become instantly better and have a better perspective on financial education. If you want to learn how to trade stocks and options, invest, and have cash flow, drop by yourinvestingclass.com. That sounds like a pretty good commercial.
Absolutely.
Drop by and check it out.
We need a phone number like 888-87,
Yeah, something.
Like,
Call
some little
now.
jingle.
Yeah, there's music jingle. So, boy, that's tempting to sing to that, and I'm going to
Go
resist.
to yourinvestingclass.com.
I'm going to resist that temptation. So anyway, Corey, just for those that are new, a little bit of your background, just to let them know who you are. And
Yeah, so I got started in the markets a couple of decades ago and went sort of the traditional route of getting licenses, Series 7 license, and eventually worked my way up to a Series 4, which is an options principal, and basically the head of option trading. And I always call it a risk manager position because I was overseeing all the risk at the firm, managing hundreds of traders at a time, and just really love the markets, enjoy the educational side, and enjoy these podcasts as well.
well, I took a non-traditional route.
Yeah.
It was interesting. I went to school and I never found my way at all. You had accounting at one end of the catalog, zoology at the other, and everything in between. And I just absolutely found nothing that interested me that I sink my teeth into. And it wasn't like finance was there, F was for failure for me, but and other things. But yeah, it was rough, right? And it wasn't until after I got out of that I became a salesman and started selling software for online investing, and that got me interested. And wow, once I read the book Rich Dad Poor Dad, I was done. I knew what I wanted to teach, what I wanted to learn, what I wanted to do. So I've been doing this a long time.
That's awesome.
long time. So we thought we'd have a discussion on mistakes.
Yeah.
And man alive, talk about a 9-hour podcast if we chronicled all this. I mean, how much time do you have mistake-wise? But hopefully by listening to some of the mistakes we've made, people might learn from our mistakes and avoid some of those.
Yeah,
so
I thought
I'll
when
start with you.
Well, I thought when you went into confessional, you had something so that people couldn't see you. We're gonna confess our sins here in front of everyone. But one of the biggest mistakes that I feel like I've made and I see other people make is in the exit, in getting out of things. And if I think when you determine getting out of something, a lot of people do that almost as not something that they've really thought through and thought about the value of the entity. They make their decisions based on whether they're up or down a little bit. So it's emotional.
Yeah.
They're getting out based on emotion or fear or whatever that exit reason is. And it's not real well thought out. And that's one of the biggest mistakes that I see people make is actually in the exit. And if you think about where you're going to make money and where your mistakes are going to be, it's usually in the exit. It's not in the entry, right? And so when I think about this from a long-term investing standpoint, I think some of the great advice out there is to try to stay in everything as long as you possibly can. You buy with the intention to own it forever. I think about some of the mistakes that I feel like I've made in my own life, and it's usually getting out of something that I shouldn't have. Like I think about real estate. If I had held on to every real estate holding, would I be better off? And I think the answer would be yes, right? And using that debt and using it where you're paying expenses to buy, you're paying expenses to sell. If I sell, then I have a tax bill.
Often.
Then I have to go find a new property. Much of those same situations happen with stocks. And so if you buy with the intention to hold forever, every asset you buy
with the intention
to hold forever.
Not
now that doesn't mean you're
not the commitment.
Doesn't mean you're locked in, but if you're on the fence, if you're saying, should I, shouldn't I, you probably shouldn't. Like try to hold forever. The reason to get out would be that it's blatantly obvious. The fundamentals tell you this is not a good situation to stay in.
Not on a technical move, but on a fundamental move.
Right.
So this is important because if you took this outside of stocks, exit strategy is an important thing. Knowing, defining when you would leave, for sure. For example, the problem with the Titanic was not that the ship sank. It wasn't incompetency on part of the captain. It wasn't because it had an iceberg. It wasn't even because the ship sank. The biggest problem with the Titanic were insufficient lifeboats.
Yep.
And so the idea that people got into something that they couldn't get out of was a bad thing. But I like the idea of intent. I don't like the analogy of marriage so much because marriage is different than stocks. But no one ever goes to the altars thinking, well, I think I'll flip this bride and upgrade. I think I'll flip this. It's usually a pretty expensive
If anything
thing.
Goes wrong at all, I'm out.
If you've gone through 5 or 6 of those, then maybe you're really going to have some financial problems. But you're buying an asset for cash flow, and you're trying to hold that as long as it's feasible. And I like the idea that fundamentally speaking, if it's just stock or real estate, you would only leave when fundamentally it's crumbling.
Yeah. And there would have to be a set of guidelines in terms of guiding your decision. And we talk about this as kind of creating your plan, right? Why are you getting in? Why would you ever get out of this? And so to use that analogy of real estate, if I buy a real estate property, I have to think about all the costs associated with that. I have to think about the expenses to buy. I have to think about my ongoing benefits of that. I've got cash flow coming in. I can write off certain things potentially as far as the debt that I have and interest I'm paying and so on. So what are the benefits? What are the pitfalls? What type of risk do I have staying in the position? And then also, what am I going to do with that capital if I do sell it? Well, now a big chunk of it goes to paying taxes for my gain, but I've got to roll that somewhere else. Is there really that much of a better opportunity? And so the same analogy really applies with stocks, where if I'm selling this nice gainer just because it went up, that's the reason. Well, that's not a good enough reason, because now I have to pay a tax on that. I have to find a new home for that capital. Is it going to be a better investment than what I was already in? I got to pay expenses and things along the way. And usually that's where people fall into a trap, is they think, well, Apple, I bought Apple years and years ago, and they think, well, I've made a couple $1,000, I'll sell it. Well, how big of a mistake was that, given how much that stock has grown over time? And did you really put that capital into something else? So I think people sell because they're up some, and they think, well, good enough. I'll go buy something else. When really that thing that's going up, when you look at Warren Buffett's best investments, a lot of the businesses that he bought had already appreciated a lot in value, but he saw the opportunity. Like Geico, I want to say it was up over 100% in price in 1 year, and he bought the entire company. That would be hard to do if you were just looking at price appreciation. You'd think, well, it already doubled. I can't buy it. No, he looked at it as a business and said, who cares that it's doubled? It has tremendous opportunity for the future. I want in. I want to own this business. And So it's the fundamentals that are going to guide your decision. Don't be making emotional decisions based on whether you're up or down. Fear and greed, those will always be pitfalls.
So selling is a bigger mistake often than buying.
Agreed.
You say, oh, I bought this, it was a mistake. But selling, if it was attractive enough to buy in the first place, if you didn't any homework at all, it's probably pretty good. I'll tell you, I think one of my biggest is kind of simple and obvious, and it has a lot to do with the education continuum. You know, when we build our education continuum, we talk about on one end ignorance, and that doesn't say people are ignorant. It just means you've ignored a certain area of you've not applied your genius to a certain area.
Yep.
Secondly, is you move from ignorance to awareness. Oh, I've learned something. I'm aware of what a spread trade is. I'm aware of what an iron condor is. And then you move into competency, which I would define as being able to get an A on a written test. But getting an A on if I gave you a written swimming test on this is the backstroke and this is the butterfly, but then I put you in the pool, proficiency might not be the same as competency.
Right.
Competency seems to be more of an intellectual assent. Proficiency seems to me to be more physical, like you could apply it and do it.
Yep.
Well, I confused awareness with proficiency. Oh, I got this. And those were some really expensive classes I put on for myself.
Yeah.
Particularly in the options market, where, I'll kind of get two birds with one stone, is I think a lot of people will position size inappropriately. So I had too much money in stuff that I wasn't proficient in.
Because you were looking at the reward, the potential to make X amount.
Well, and I was deceived by probabilities.
Yeah.
I mean, when I say, like in my basketball brain, if someone's a 90% free throw shooter, somehow that's not 100%, but it seems like it.
Yeah.
Right? So I'd have these high probabilities. And then that one little 10. I think more people blow up their options account doing that.
Yeah.
Looking at high probability, but high risk. And not like the lesson I teach in my 4 pillars class on this has to do with, and I trick people. I did this with my sons. I say, imagine going to the grocery store and purchasing a carton of milk and coming home. High risk or low risk? And everyone says, well, that's low risk because they've done it all the time.
Yeah.
I say, no. High probability of success, huge risk.
Yep.
Anytime you get in a motor vehicle, what's the worst thing that can happen? Well, you could lose your life or take someone else's. And so so you look at what the worst case scenario is, and that's your risk. And then you back out there, understanding that nuance between probability and risk. That was a hard lesson I put on for myself. So, I don't see you ever doing that. Like, your personality is so thorough. You would always, if you ever made any mistakes like that early?
Yeah, everyone kind of that has done this from years past. I think there's enough education now that we can help people avoid it. But we all started when the options market was the wild, wild west, right?
Yeah.
Like, we were doing it 20 plus years ago, and totally options, different. It's just different. Like, there were not weekly options. There were just not a lot of the same things.
Spreads were bigger.
Spreads were bigger, and the risks and the rewards and all these things, we didn't know as much back then. And I was kind of an expert in the field, and I still didn't know what I know today, right?
Interesting.
It's really gone forward. Just in the last couple of decades, the options market has exploded in popularity, but also, like, the education that we put on at the Cash Flow Academy will help people to avoid those mistakes. But we all did. I had a couple of learning experiences. I tell a story about being in some naked options, because I thought it was the same thing, where I thought, well, high probability of success. And I was short naked calls in Kmart. Now, if there was ever a company that you were betting was going to go down,
100%.
Kmart
fundamentally was dying.
Trash, right?
Yeah.
Well, Eddie Lampert, this is a 20-year-old story, but Eddie Lampert was this famous guy that had been kidnapped and all these things that, he was a fund manager. Well, anyway, he took Sears, which was another struggling business, and he combined them with Kmart to create Sears Holdings, and it was the two entities, and they were going to try to
fix
two wrongs
don't make a right.
Yeah, but what do you think the stock did? It exploded, and I did some risk management. I understood more than most people do.
Sure.
And I got out before it was devastating, but I look back at how much that stock appreciated later on. And if I had just kept sticking to, it's a bad fundamental business and this and that, I'd have been devastated before eventually it did go bankrupt. But it's sort of the GameStop scenario. Yeah. GameStop's heading towards zero, it seems, again, but it went to hundreds per share
because of
just chaos.
Detachment from fundamentals can happen.
Exactly. And so that's why we always say that's another lesson in risk management is the risk on the short side is always higher than the risk on the long side, meaning long means you buy something. So if I buy a stock at $40 per share, it can only go to zero. That's it. That's my worst case. But if you short something at 40, it can go to 80, which is like it went to zero. Then it can go to 120, which is like it went to zero twice. And now 160, it went to zero 3 times on you. And so the short side is always the more dangerous. So, those are mistakes that we help people to avoid. But you can limit your risk. You control your risk. You can put on trades that are low risk right from the start. And that's the beauty is once you get the education, you don't even need to bother with those high risk or potential risk type of positions. You can just avoid them or manage that risk of it.
I think some of my biggest mistakes were actually things I didn't do than what I did. Yeah. There's that old saying, and I don't know if it was Samuel Clemens or I think it's another gentleman that's often attributed to Mark Twain, but it's not, where he says, 20 years from now, you'll lament more what you didn't do than what you did.
Yeah.
Boy, is that true. I mean, I think about my risk tolerance as it's grown as I've gotten older, which is usually backwards. Most people, their risk tolerance goes smaller as they get older, but mine has gotten, just personally, because I've learned, boy, there's so many risks I would have taken, not just financially, but in my life, like just period. Yeah. Even as a teenager, I wish I'd have done more and tried more.
Yeah.
And as I look back at some of the, hindsight's easy, but I look back at some of the no-brainers that I should have hopped on, but I didn't have any education. So taking action's a big, like the failure to take action is a big mistake.
You can't live in your worst fears, right? You can't live with, well, this bad thing could happen to me. And this, if you constantly live like that, you're never going to go outside. You're never going to get on a plane. You can't live in your worst fears. Yeah. And so at some point you have to step outside of your comfort zone and kind of push yourself. And I've done the same thing. I mean, I've had to push myself in different areas because I'm kind of risk averse. Yeah. I mean, I live my life in sort of I'm content
very
and
prudent.
Not too aggressive. Yeah. And so I've really had to understand that I have to push myself a little bit to take more risks and to do more things, which actually leads to one thing that I did that personally was a mistake, which is the first home that Jackie and I ever bought was just a small home, and we remodeled and so on. And I remember I made extra payments to pay it off early.
Yeah.
And I look back on that, and that was a mistake. Yeah. Right?
I
own it outright, but if I look back, what could I have done with that capital that I was putting into it to pay it off earlier?
Right.
And especially another mistake was maybe, even though I had paid it off earlier when interest rates were higher, this was, again, 20-ish years ago or whatever, but what I could have done just a few years ago, rates were down at 3%. I could have gone and taken out a mortgage on it.
Can you imagine?
And I'd be borrowing at 3%, but do I feel like I can always beat that? So again, it's kind of a risk thing. Some might say, well, there's a psychological advantage to having that mortgage paid off. And that was my philosophy, was sort of, well, if I have that one paid off, then I put renters in there. They'll be paying my mortgage for the next one. And then, I rent that one out. And now these two renters are paying my mortgage here. And I basically avoid payments because I've got other people covering my payments. Right. Was kind of the philosophy. But ultimately, looking back, it's always hindsight's 20/20, right? But certainly, especially when rates are at 3%, some of it's logic. If my mortgage was 8, 9, 10, paying it off early might not be a bad decision. When they're at 3%, paying it off early is probably a wasting opportunity, really.
See, and when I've refinanced real estate to get more debt, because, if you'd asked me 30 years ago, I would have had no concept of this 30 years ago, of shorting the dollar.
Yeah.
And now I'm like, think of all the bets you would take. Like if you had to predict it, if I gave you a 20-year prediction, I go, you got to look in your crystal ball, go 20 years in the future.
Yep.
Do you want to guess Bitcoin's price in 20 years? Do you want to guess gold's price in 20 years? Do you want to guess Apple's price? Or do you want to guess
the dollar?
Up or down?
Yeah.
What are you taking?
The dollar going down. That's
100%.
That's the guarantee.
100%. It's the closest I can get guaranteed.
Yeah, it's not a sure thing, but it's a 99% probability. So much so that they even tell you they want inflation to be at 2%, which means your dollar's losing 2% of its purchasing power.
30-year mortgage.
Yeah. I mean, they're saying our goal is for your dollar to lose purchasing 2%. Power.
You should.
So
what does that mean? I mean, if you had to do over again, and you were, let's say I could go back to like age 30 or 25.
Yep.
I'd have gone into debt as fast as I possibly could, as deep as I possibly could, and bought as many assets as I possibly could.
And that was my point. Like, I don't live that way anymore, but 20 years ago,
that's how we thought.
Well, 25 years ago, I paid extra on the mortgage. And then I learned better, 10 years after that. I kind of thought, well, that's not really smart. But so for the last while, I maybe haven't been living in that way. But before I was, it was a different mindset.
Not having who'd have ever thought not having enough debt would be a mistake? But it is.
It is.
The biggest, the other mistakes I've made have been temperament. I have really, I say this often. I don't know if I say it effectively, but as I think about my life as an investor and as an entrepreneur, both, those ventures will find your weaknesses of your persona, your personality, it roots them out some way and puts them on display for the world to see. And I'll tell you, a lot of my mistakes weren't just ignorance; they were temperament mistakes, lack of discipline, lack of consistency. There were some times early where I'd get busy and I'd be in positions that needed attention, and I'd go a day without looking at something I should have looked at. And next thing I was like, oh my gosh, what happened? And had I just like just a lack of vigilance. So as I grew as an investor and as a trader, I think about investing in stocks and trading options. That's the way I think about it. Is the stocks I don't worry about too much, but options you got to keep an eye on. They're time sensitive.
Yep.
And so you got to find out how much time you want to put in, how much maintenance you want to have. And I've found a nice place where I've settled, and I think everyone's different on that. But mistakes of temperament, I look at when I read The Intelligent Investor, and I try to read it about once a year. That's a book on temperament to me, more and more and more, rather than a book on, they got the big securities analysis doorstop book that weighs 15 pounds. And then you have The Intelligent Investor. It's about temperament. I've made a lot of temperament mistakes early. Not so much, in the last decade or so, but early. Oh my goodness. Like the first 2-3 years. Oh, it was just, my temperament was awful for being an investor.
Yeah, and temperament's huge. I mean, that's kind of that thing about greed and fear and these emotions that you feel. And like you said, I don't know how the world figures out how to mess with your,
it does.
Pushes your buttons, right?
Yeah.
And we all feel the same way given certain circumstances. Like if you take one individual, they're kind of hard to predict. But now you take the entirety of the world, the market participants, and we feel certain ways in certain environments. And I've trained myself to basically root for things differently. So most people kind of root on, I want the market to go up as fast and as quick and as sharply as possible. And to me, that means everything that I'm going to be purchasing, and I'm a net buyer, right? I just want to acquire assets. That means everything gets more expensive.
Yeah.
And so I naturally kind of feel, it's not that I'll stop buying, but I'm more selective. And then I train my brain, because we're all instinctively, we're going to feel pain when the market goes lower, right? The market goes down. Oh, my stocks are down. People are losing jobs. Housing prices are down. And you just feel a certain way. And it feels like, in those moments, it feels like the economy may never recover. Like people
it does.
It just
COVID.
The uncertainty. Yeah. And then you wonder, well, we'll probably recover long term, but maybe it'll take too many years. Maybe it'll take 3 or 4 years, and you just feel a certain way, and you have to train your brain to flip that switch and say,
that's
no,
Buffett.
Here's the opportunity.
That's Buffett.
I get
his
greedy
essence.
when people are fearful. I get fearful when people are greedy. And that is very powerful as well. Like, I tell this story about energy prices, and it was this was a number of years ago, but I remember oil had been up in the hundreds for a number of years in a row. And then it kind of dropped below 100. And I was at early morning basketball, and the dentist said, hey, how do I get invested in oil, buying oil futures? And this was around Thanksgiving.
You're playing basketball with a dentist?
Yeah. True story. Well, we mostly sit around and talk, and then we try to play a little bit of basketball. But Tuesday and Thursday mornings, you can come join us.
Oh, my goodness.
And then I went to Thanksgiving. This is 4 or 5 days later or something, and my brother's like, oh, oil prices, they're going to go back up. And I started thinking, like, there's so much, these are not people that are involved in the markets. This is just the general public.
Yeah.
And so it's kind of a market tell. When everyone is convinced that something can't go down, what did oil do?
Yeah.
It plummeted so much so that it went to 80, 70, 60, it went to 40. And then, no fault of its own, COVID hit, actually went negative in the futures markets for a while. But for years there, it was spiraling as everyone thought oil just had to stay up. And I take the opposite side of that is, when people are too convinced that houses have to go up, that stocks have to go, when Bitcoin has to go higher, and everyone's talking about it at the Thanksgiving dinner table about what coins are we going to buy? Are we going to buy this Litecoin and this coin and Bitcoin, whatever? Then that there's a certain level of euphoria. It might not be the top, but when the general public is too euphoric on something, when there's too much greed, chasing, hey, I don't want these people to make money without me, that kind of the envious buying that's taking place, that's usually a time to say, I don't want to buy that right now.
Yeah. I think one of the biggest mistakes is being afraid to make mistakes.
Yeah.
I remember when Kim Kiyosaki said, Andy, you should be a teacher because you make this stuff simple. I felt that was above my pay grade, because I had not yet really had a grasp of the markets that I thought someone could have, right? I knew some stuff. I knew some good stuff. But I was so afraid during that time of doing things. So I thought, well, if I'm going to be a teacher, I'm not allowed to make mistakes. And that lasted for a couple of years for me, where I invested less aggressively, and I got scared because I thought, well, if I'm going to be a teacher, I'm not allowed to make mistakes. And it petrified me. And I realized I'm missing out on huge lessons, because the purpose, never waste a good mistake.
Yeah.
The purpose of a mistake is to learn. That's what, or I don't know if it's the purpose, but it's available. Those lessons are available to glean.
Yeah.
And I'm so grateful for my mistakes, because nothing teaches you like a really nice mistake that can hurt a little bit, right?
Yep.
And as I look back at losses that I've had, and stupid mistakes, well, they haven't been repeated very often.
Yeah.
There's something about that where you just really learn. It's like your amygdala or something kicks in and says, okay, we've been there. That was really bad. We're not doing that again.
Yeah, that felt painful. Let's avoid that same pitfall, and that's the point of this discussion, is to avoid those, right? Help people to avoid them. And I mean, I think that's a great point that you made.
You're still going to make them, though.
You're going to make them.
You're going to make yours.
You're going to make them, but think about your own life. I mean, I think about my net worth, my net worth has been steadily climbing almost every year of my life, and I've made a ton of mistakes.
Isn't that something?
So what does that tell you? It tells you that the mistakes are not the problem. Inaction, the inability, like if I don't take a step forward and start getting involved, who knows where I'd be? My net worth wouldn't be climbing. I'd probably be further in debt. You know, you think about the consumer that doesn't own any assets, and they just have to keep paying higher prices, and they have to hope that they get, that their job gives them a raise. And if they don't, well, they're just stuck with paying higher prices, and they have nothing to counterbalance that, right? And so if you acquire assets, you're going to make some mistakes along the way, but that doesn't mean that you have to be perfect to make money. You can make money making a lot of mistakes.
It's such a mistake to think about price all the time rather than asset acquisition.
Exactly.
I mean, I love the idea of I have another, 2,000 square feet of real estate in the world, or I have another X amount of shares of a business in the world. And when you look at what you're actually buying, square footage or percentage of a company, if you look at it that way, it always grows. Yeah. It always grows. And the prices fluctuate up and down. But if you can get that, if you can understand that, I'm filling my asset column with more, and the square footage I own is going up, the number of shares I own of companies is going up, that's a plus. And that's how, and net worth, but net worth, that's how your cash flow comes. If those are all machines that create cash flow, then your cash flow will grow as well. There'll be fluctuations in net worth, but the amount of asset you own is huge.
The amount of assets, and then also the cash flow, like you said, is a reflection of that. So as your net worth is climbing, your cash flow should be climbing. Like my cash flow from investments has steadily climbed along with my net worth climbing. And again, lots of mistakes mixed in, but that didn't destroy what I was building. It just, hey, there's some lessons along the way. Maybe if I had done this instead of this, I'd be a little further ahead, but that's part of life, right? We screw up sometimes.
I did a podcast earlier with Greg Arthur he asked about, dividend kings or king dividends.
Yeah.
I don't follow that. Right.
Yeah, the dividend aristocrats
in the S&P. So the aristocrats are 25 years of growth and members of the S&P. The kings might not be a member of the S&P. They're 50. And it was crazy. I looked at one of them. It was American Water. I've never owned it. It was a utility. It's number one. That's 69 years in a row they've raised their dividend.
Isn't that something?
I mean, think about everything that's happened. That's like my dad's lifetime almost, right? I mean, save 16 years. An increase every single year of some kind.
In dividends.
Regardless of what wars we're in, what pandemics we had, what market crashes were there. They just pretty amazing stuff.
Yeah.
Well, as far as mistakes go, I would say, and I've also learned from the mistakes of others. Mm-hmm. And temperament mistakes. I watched people have money take over their life and lose perspective. I've seen people engulfed by the pursuit of money where they really missed out on life and made their life about money instead of money serving them.
Yep.
I've seen one of the biggest mistakes we alluded to earlier is people position size to reward as opposed to position size to risk.
Yep.
I've got caught in that, not in the same way a lot of people do. Like a lot of people say, okay, my car payment is $1,000 a month. I'm going to do this iron condo because it's make me $1,000. I'm like, okay, that's not the way that works at all.
Right.
And people blow up their account doing stuff like that. So you always position size to risk, never to reward. And you learn those lessons. A lot of it, this is the education continuum. Don't be investing in things. If you're investing in something you don't understand, that's a big mistake.
Yeah.
Giving money to Wall Street's a massive mistake, in my opinion.
Cut out the expenses. Cut out the needless expenses.
401k is probably the biggest mistake in the history of finance for people. That was a total mistake. Literally not planned out. Literally was a mistake. No one had planned it out, or there was never a think tank of smart women and men that said, let's come up with this. It was just a mistake that grew. Butterfly effect type stuff. So it's great stuff. Great to have your confessional. that yes, Corey Halliday has made a mistake before. Yeah. You've actually lost money before.
Yeah, absolutely.
Oh my gosh, yep. my whole world is shattered now.
Yeah,
it's
and Michael Jordan's missed some shots, and he's still, in my opinion, the greatest ever. But if you're a LeBron fan, well, he's missed some shots.
Guess
too.
Who's missed the most?
Well, probably
Kobe.
Kobe. I was going to say Kareem.
I don't know. It might be. It might be LeBron now.
Yeah, maybe.
I haven't checked that stat in a while. It might be LeBron now.
Those guys went. Those guys went straight from high school. Yeah. So
you barely had. I think Pop took over Don Nelson or someone. Don Nelson had won the most and lost the most. It's just what it really
longevity.
Is about being around a long time, right? And it's the same with your investing. You mentioned, I made these mistakes, but I've also had my net worth grow every single year.
Yeah,
that's insightful.
Yeah, that's the point.
Awesome stuff. So let's do our commercial. Go to yourinvestingclass.com.
We'll sing it. Go to yourinvestingclass.com.
Oh, that's bad.
All right, cut. Edit.
Yeah, no. But go to yourinvestingclass.com. Make less mistakes. You're still going to make them. Don't be afraid of that. You'll learn from every one and learn from the mistakes of others. So go there, check that out. Hope you enjoyed our conversation. Corey, thanks for hanging out.
Yeah, excited to be here always.
I love these times each week where we get together.
I love it.
Get a chance to talk about investing. So you've been listening to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we try to make investing simple. We'll see you next time.